Time now for On the Radar, where we ask an investing professional what they're looking at in today's markets. We're back again with Colin Stewart. He's Chief Executive Officer and Portfolio Manager at JC Clark to talk about, Colin, something that's on the mind of a lot of Canadians and a lot of investors, and something that has economic consequences in a big way, population growth in Canada. How do investors get properly positioned?
Yeah, well, a couple things. I mean, last year in 2023, we saw the highest population growth, 3.2% in Canada in 50, 60 years. So it's really remarkable what we're seeing, and that's largely been driven by immigration and then temporary workers as well. So, as investors, we've tried to think about how can we benefit for this, what companies are going to do well. And I think, one of the key things is real estate. People who are coming to Canada need a place to live. There's a huge push recently we've seen by the federal government to build, millions of new homes by 2031. I think 3.87 million new homes is the goal to have those built. And there are many different programs in place to drive that. So, a couple of companies that we think are well positioned. One is InterRent. It's a owner of apartment buildings in Canada with a portfolio largely based in Ontario and Quebec. A lot of these in-place rents are lower than the market rents, so when units turn over, they're able to increase those rental rates. Sometimes the uplift is as much as 20 or 25%. They just reported a very strong quarter of 11.7% same property net operating income growth, so strong results, well managed. So we think that's one interesting way to play the trend. And another company called Dream, which is really a diversified real estate company run by a fellow named Michael Cooper, been around for a long time. It's a well-managed business. They, increasingly are focused on recurring income from multifamily industrial properties and asset management, but they also have this very valuable, very large, one of the largest land portfolios in Western Canada. So huge tracts of land in Saskatchewan and Alberta, which we believe are very desirable places to live, obviously lower cost of living, a lot of job growth. And I think as immigrants come to Canada and looking for more affordable places to live than perhaps Toronto or Montreal, I think Western Canada is going to benefit from that. And a company like Dream is very well positioned to develop that land, sell it to home builders. And in addition to that, it trades at a very large 55, 60% discount to its net asset value.
And when you're talking about Dream, you've got to be very careful to distinguish between Dream Unlimited, which is residential real estate, and Dream Office, which is another REIT, which obviously holds office real estate, where the fundamentals are perhaps quite different.
Yeah, and it's one of the subsidiary companies, and I think Dream owns a very small amount of units in Dream Office, and they were behind starting it. But really, we very much favor the Dream, the parent company that has, as you said, residential exposure, will benefit from immigration and housing trends, and would be a little bit cautious in office right now.
There are other real estate investment trusts, REITs, that specialize in apartment real estate. Boardwalk is one.
Yep.
CapREIT is another. Why do you favor these two?
Yeah. I mean, I think they're both excellent companies as well, and probably they're all going to benefit, frankly. But InterRent is a company we know fairly well. We like that the faster growth perhaps of InterRent relative to the other players. It's a little bit smaller than a CapREIT, for example, something that's got more growth opportunities. We like the fact that they're in key cities like Ottawa, Montreal, Toronto, where we think a lot of population growth is going to occur, and a lot of people come because that's where the jobs are. So I think they're well positioned, as I said, to benefit from these trends.
Okay, let's go to another thing that's on your mind. India, a remarkable story of population and economic growth. And I think a lot of investors are wondering, how can I safely invest in India? Because there are pitfalls there.
Well, for sure. I think anytime investing in sort of a developing market or foreign country, a lot of risks. And if you don't understand the nuances of how the stock market works or businesses. So, we certainly think that the overall macro story in India is very, very powerful. It's going to be the third largest country by 2027. They're the largest democracy in the world. I have almost 1 billion voters. There's an ongoing election underway right now, which I think is going to be decided on June 4th or 5th. And it's very likely that Prime Minister Modi is going to be reelected with a majority, as he was before. And his policies have been very, very positive and powerful, bringing capitalism and pro-growth policies to such a large economy. I think India is also benefiting from this sort of move away from corporations to move their manufacturing away from China to some degree. So the way we think investors can play this is Fairfax India. Obviously, everyone knows Fairfax Financial. Very astute investors. This is a subsidiary company that they own 43% of, but have voting control. And it is basically an investing holding company that owns about 3.5 $3.6 billion of public and private investments in the Indian market. And I think, one of the key investments is a 64% stake in the Bangalore International Airport. So they're involved in infrastructure. And we think there's just going to be huge continued growth there. Fairfax India trades at a 30% discount to its book value per share. So not only is it traded on the TSX, safe, trades at a discount, you've got a very well-regarded, well-connected management team with people on the ground in India that are managing this and making investments on your behalf. So overall, we think it's a great way for Canadian investors to get exposure to the Indian growth story.
Well, TD Bank is set to report earnings tomorrow. Investors and analysts will also seek some clarity on some of the uncertainties right now. The bank has been in hot water as it faces a series of money laundering probes in the United States in connection with the illegal drug trade. Earlier, we spoke with Richard LeBlanc. He's a professor of governance at York University Law School.
It could be a lost decade for TD. The American investigatory bodies, the fines are predicted to be $2 billion. So this is not a rounding error. TD was alleged to have laundered hundreds of millions of dollars through branches in New Jersey and New York by employees accepting gift cards. So in theory, John, OSFI regulates anti-money laundering and internal controls, and the system should work. However, when you get large very quickly and you acquire and you have a foray into the U.S., those are risks that any good board of directors would be asking the CEO about.
And what do you think the biggest boardroom questions are going forward?
Well, obviously, how could it have happened? OSFI gives internal audit a line of sight to the board of directors. So internal audit should be reporting right into that boardroom on the adequacy of the controls. The second conversation that a board should have is the tenure of the CEO. We now have Mr. Mansouri is 67 years old. He's been at the helm for 10 years. Same as the Royal Bank of Canada, a 10-year run, and same as CIBC, a 10-year run. There has been some talent exodus, John, from Toronto Dominion, senior managers that were deemed to be near CEO ready. So succession planning should be on TD board's radar screen. And in particular, should we go to the outside? Do we have internal talent that is CEO ready? You saw last year that Bank of Nova Scotia went to the outside. Normally, you don't go to the outside, but there is somewhat of a precedent to take a look at the outside talent available.
And when you're trying to address both the issue of controls, but also CEO succession at the same time, what goes into the thinking there?
Well, the conversation in a boardroom then would be, and I've seen these types of conversations, and you could even apply this to the Toronto Blue Jays, who have been underperforming for the last 3 or 4 years. And the conversation goes like this, John, is the people at the helm who either oversaw the problem or created the problem, are they the people to solve the problem? And that's, a legitimate question that a board will ask is, should we initiate a change now, or should we wait this out? The argument, of course, for waiting it out is that you've got a seasoned CEO at the helm, and they understand what has occurred. They're able to make it right. The counterpoint to that is, it's a time for change, and the board sets the tone from the top. And the argument also is that the people that got you into the mess are not the people to fix the mess, hypothetically speaking. But that's the type of conversation when you have an intersection of a significant internal control failure and a succession. That's the type of conversation that often occurs.
And what about the communication around all of that? Because we don't really know much about the road ahead on the CEO front. And we also still don't quite know what the net financial penalties will be. I'm sure all the analysts are going to want to ask questions about that this week. So what can a company communicate when there's these sort of big issues, but it's hard to know when you're ready to actually start talking about all of this?
Well, on the controls front, TD has said, listen, we're going to hire an AML executive that will report directly to the CEO. We've set aside $450 million. We're spending $500 million on internal controls. So you want to continue that transparency. Where there's potentially a lack of transparency in the media reporting is that there's not really a line of sight by investors to whether internal candidates are CEO ready or near CEO ready, and what that succession plan looks like. So you want to hold your cards close to the vest if you're a board in terms of, who the candidates are and their readiness. But at the same time, you want to be transparent with investors that we understand that it's our, and I say, John, it's the number one job of a board is CEO succession. So you want to, I would suggest maybe being a little more transparent now, given what's happened in terms of the talent and the development of that talent and how that is occurring without sort of naming names. I think TD can be transparent in that regard as well.
Shareholders in BHP are wondering if the world's biggest miner has moved a step closer to a takeover of Anglo American. That deal worth well over $40 billion. Anglo rejected a third improved takeover approach, not a formal offer as far as I know, but it has agreed to talks and given its suitor an extra week to commit to a binding deal. Our guest says we haven't seen that much M&A activity so far in the mining sector this year, but it should accelerate, especially if the price of copper continues to go up. We're joined by Scott Bauer, CEO of the Prosper Trading Academy. Scott, it's always great to talk to you. Thanks very much. Actually, before we get into mining M&A, what about this short squeeze in New York in the copper market? Is that the thing that pushed copper to record highs this week?
I don't know if it was as much of a short squeeze as it was a little bit of FOMO, fear of missing out. Many other metals and other commodities pretty much all across the board rallying to, highs that we haven't seen in a while or even all-time highs. So, copper certainly was no different, certainly caught up with the rest of them. So I'm not so sure it was, again, as much of a short squeeze as it was, there's some catch up to do here.
What about the M&A, the BHP? It looks like Anglo American has decided, well, there might be something here for our investors, and they're talking to BHP.
Yeah, and it's a little bit surprising that they were given an extra week. If they don't get a deal done by next week, then BHP is out of it for a minimum of 6 months. Those are UK regulations. They're not going to be able to come back to the table. But the fact that they are at the table, it does seem to be getting a little bit closer. And from my understanding, Andrew, it's not so much the absolute price, the dollar amount of the entire transaction. It's more, what is BHP going to be able to do with Anglo's concerns around execution risks, especially with what's going on in South Africa?
South Africa is kind of the joker in the pack here, isn't it? Because it is a major shareholder in Anglo and presumably could block this deal.
Oh, there's no question about it. So, the Anglo's main concern is what's going to happen to its businesses in South Africa. So, it is going to be a tough one. It will come down to the wire. I think that it will happen. If I had to, give a guesstimate on it, it's probably 60-40 that it will happen. But if it doesn't, I think you're going to see another suitor coming into play.
It's just too attractive to have copper mines these days, and it's such a daunting prospect to build the mines.
Oh, that's what it is, right? To build a mine right now, it is so cost prohibitive. It is much easier, I don't want to say less expensive, but much easier for someone to go in and buy a company because of the massive amount of overhead that has accumulated now. You've got declining ore grades, you've got stricter environmental requirements, and obviously rising labor costs. So that is really a barrier to entry for building mines here. And I really think that if copper continues at these prices that they will, that's going to force the hands of many companies out there.
We just were looking earlier at a calculation by Reuters that copper inventories worldwide have gone to a 3-year high. Now, of course, some of that's tied up in warehouses, and nobody knows where all of the world's copper is. Humanity uses, what do we produce, more than 20 million tons a year around the world, and lots is recycled. But is there a case to be made that copper markets are pretty adequately supplied right now?
I think they are adequately supplied right now. The issue is what's going to happen in 5 years, 7 years, 10 years. The expectation is there's going to be such increased demand due to, energy efficiency, EVs, the like. That's where the issue comes in. So if you're looking short run, there's probably, supply and demand is in check. Going out, especially if China makes any sort of recovery, that could be the bogey in the whole thing here. But if China makes any sort of recovery, that is really going to push demand.
Yeah, that's interesting. China, arguably the main braking factor on copper right now, if it has one. Give us another, anything fresh on uranium, Scott. I'm not even sure how closely you follow it, but we did see Cameco, our big uranium producing company, its shares hit a new record high this week, CCO.
I think the theme for uranium is very similar to copper, that we are going to see many more M&A deals coming up because, there you're really in a supply and demand issue. Not so much with copper, but uranium you are. And right now the demand is far outweighing what we have in supply. So I do think you're going to see a lot of M&A activity coming up the rest of this year.
Markets are in recovery mode right now after a pretty sharp sell-off yesterday. Let's bring in Mike Vinegar, who's portfolio manager at MV Wealth Partners, part of IA Private Wealth. Here we are taking a look at some nice green on our screen. Yesterday was a pretty washout day, and we thought NVIDIA was going to save the market. It really just saved itself. It was like the Rose on Titanic. She just saved herself on that doorboard. But the Fed and rate cuts and that prospect seemed to really weigh on things yesterday.
I think that market was a little bit overbought. There was a lot of anticipation into the print. The print was good, but if you look at the point count, I think markets would have been down a heck of a lot more had, NVIDIA's action hadn't been buttressing, in the underneath of the market plumbing, right? We've known about the Fed. We've known about where the economy is. These are not new topics. We're not surprised. This was, in our view, probably the last kind of gasp into the long weekend. Memorial Day's on Monday. You usually get kind of maybe a run-up or a reversal of the previous day. But we think that we should be in a corrective period. This is typically the time when you get some kind of a seasonal correction. We're not saying sell in May and wait back to October. We're saying sell in May and maybe revisit into the end of June. So looking for a small correction. How small it'll be, we'll see. I don't have a perfect crystal ball, but I would think 2 to 10%. I know it's a wide range, but it depends on what happens with geopolitics, interest rates, commodity prices, fund flows, et cetera.
And I guess that pullback is not really a warning to sell, but maybe an advice that if you have stocks that you like, that you're maybe missed the boat on, that you might get a nice opportunity in the next month or two to add them to your portfolio.
Absolutely. So we're not saying run away from equities. We're saying keep your powder dry. There are some very interesting opportunities. We have a huge buy list that we've been developing. But as value investors, we're very price sensitive. And so we want to make sure that when we buy in, we have a margin of safety. And so we're patient.
So what's an example of one of these stocks that you're desperate to buy at a cheaper valuation?
My God, there's so many. Norfolk Southern, one of the big railroads in the U.S. We quite like what management is doing. With all the reshoring going on.
It's come off quite a bit. It's not cheap enough yet?
Not yet.
Okay.
Not yet, because remember that Norfolk is part of the transportation index, and we believe the transportation index is going to have a little bit more pressure on it. It's got a typical seasonal pattern going down into June. So we think, 5-10%, so maybe below $200. That could be a very enticing price point to get in.
I'm glad that you brought up the transportation index because that is a sector that is not doing well. It's not just the rails, but it's also the truckers. And, you know, traditional lore has it that it's not good if the transportation index isn't doing well. It doesn't, you know, telegraph great things in the economy. Should we be more cautious than you are about the markets given the transportation maybe flashing a warning sign?
I don't think so. And I think part of the reason for that is that, first of all, we're not buying the index necessarily, we're buying companies. Mm-hmm. So I always caution people that no matter how bearish they are, there are some wonderful businesses, wonderful management teams out there that if you buy them at the right price, you will be successful. Having said that, I think that there's one tailwind that, you know, is not really necessarily baked into prices yet, and that's the reshoring, right? So if you think about all of the transportation within the continental United States that needs to occur due to the reshoring, on top of that, all the world trade, you know, people think that world trade is down. It's not. If you look at cargo shipping rates, they've been up, because of the Red Sea and the Houthis and all of that stuff. But you know, trade is proceeding at a pretty robust clip, and, you know, GDP is hanging in there. So that means goods are still moving.
Is Norfolk the only rail? Because CP Kansas City has also been under pressure, CN to a lesser extent, but they're all under pressure.
Right, but we like the management and the opportunity to unearth value at Norfolk. So that's one. FedEx is another. Full disclosure, we own FedEx. We got in.
So a lot of transports.
Well, it's not specifically the transports. Again, yes, they are both transportation stocks, but in both cases, management is key. And management has really got a lot of levers to pull. But there's a lot of other opportunities that we're finding in many other sectors, like financials, like healthcare, retail, insurance. In
financials, you know, when you say management is key, it makes me think about TD. We were just talking about this stock yesterday, and they've got this big issue with the anti-money laundering stuff that they're dealing with. I wonder if that's the only thing keeping the stock down. What do you think? Like, if operationally they're doing what they're supposed to do, would you buy this?
So we like TD.
Okay.
We are looking at TD. TD, in our opinion, is a premier operator, but we think there's going to be more pressure on the banking stocks in general and TD specifically. TD specifically, we think, because there's a big red flag right now on them. And the problem is, we don't know what the size of the fine is going to be. There are many regulators now probing into what happened and where the dysfunction was. Number two, there's going to be most likely a lot of investment into IT systems for command and control purposes of AML and other variability in their operations. And then C, they're going to most likely be precluded from either buying somebody or expanding. I mean, they are already the 10th largest U.S. financial, so that may not be a huge issue, but they've also been very good at doing tuck-in acquisitions, which is probably off the table for the next little while. The bigger issue for us is the credit cycle. And we've been thinking about this for a while. We don't know when it's going to happen, but we're fairly certain that these loan loss provisions are not at the end. They're maybe at the middle of the stage, and we still have another 2 to 5 quarters to go. So we think banking in general may be a little bit under pressure, but TD especially.
You know, you mentioned healthcare, and that's a really fascinating sector right now, especially for a value person.
Yes.
Because you got to make sure you don't get caught in a value trap.
Right.
And I imagine there's a lot there to lure you in managed care, in biotech, you know, in pharmaceuticals. You have a Pfizer. In the pharmacies, you've got CVS, Walgreens, a lot of basket cases.
Right.
Are you picking up any of those basket cases?
So full disclosure, we do own CVS.
Okay.
And we are looking at averaging down and picking up a little bit more. We think CVS is a wonderful operator. We did own Cigna, and we sold it higher. It's now pulled back. Not enough of a pullback for us to re-enter, but certainly, definitely on the list. One of our favorite HMOs, a wonderful operator, great returns on capital, great cash flows, wonderful risk management. In insurance, we do own Manulife.
Okay.
Still.
Yeah.
It's up a lot. We think there's still upside there. We did own Jackson Financial. It was a huge win for us. If that one pulled back, we'd look at it again. Bright House Financial is another one that we would look to at a cheaper price. So you got to pick your spots because, to your point, within the sector, there are places where you may want to participate, and there are places that, to your point, a value trap you want to stay away from.
Well, let's use your CVS as an example. You want to average down and buy, and we just saw it's been eviscerated. Then compare it to competitor Walgreens. Is that a value trap?
Sort of like Coca-Cola and Pepsi. Yeah. I think Walgreens missed the boat on diversifying their platform. I mean, they sort of tried to do it after CVS did, but I think they did it too little, too late. CVS has a great management team. They have a great store footprint. But between their pharmacare business, their medical practitioner business, their HMO business, and the drug business, you've got like a mini conglomerate, but within the health space.
Yeah.
And we think that, while some of their acquisitions panned out better than others, they have so much cash flow and so much free cash flow to pay down the debt, to keep paying that dividend out, to keep re-diversifying their business. Whereas Walgreens, at one point in time, you would have said Walgreens was one of the best managed companies on the planet. In fact, if I'm not mistaken, there was a book that was written about Walgreens and about how, the management for so many years was so pristine. Somewhere along the line, something fell off the rails. And I don't know exactly when, and I couldn't pinpoint it for you, but that's how companies are dynamic. And we as portfolio managers, we have to keep a very keen eye on what management is doing.